Hello everybody, this is Henry. Putting together, as you can see from the title, a market and portfolio update slideshow. And to keep it brief and file size small, I'm going to jump right into it. So the bottom line is I want to be sure everybody, client-wise, is on board with my view of the markets, or at least understands my view of the markets, as well as how portfolios are being managed at this point. I'm using a slideshow because it's a great way of communicating with everyone in a timely fashion versus I'm all for meeting with clients, talking to clients, but that would literally take me weeks to do that. And obviously, whoever I start with is going to get the information faster than whoever I end with. So, keep in mind, I'm always happy to speak one-on-one with any client. So, as I said, I want to check in with clients on strategy and portfolio. So, let's get started. So here we have a chart with three things on it, and I'm going to use a pointer here. The gray line is the Dow Jones Industrial Average, as we see at all-time highs. We have the 10-year Treasury bond, which is kind of indicative of interest rates, we'll call it. It's the 10-year Treasury yield, as we see, has come down as interest rates have come down. And we also have the red line, which is the U.S. dollar. Okay, so and we're going back to 1985. So the observations in this chart are, one, that we keep seeing we're seeing successive peaks, higher peaks in the Dow Jones, also lower lows in the Dow Jones. It's not a coincidence that we see the market fueled up by lowering interest rates and destruction of the U.S. dollar value. These are not accidental. These are worrisome, quite frankly, because I guess the question is, what's the policy response by the Federal Reserve should we see some type of systemic event, whether it's in this country or Europe or Japan, that really rocks the stock market? The policy response in the past, in the dot-com blow-up and in the 2008 blow-up, the first policy response is to lower interest rates to try to fuel the economy, flood the economy with money. How do you think that would go over right now? You can't take interest rates any lower than they are. They're already zero. Then the other question is, we're already printing $85 billion a month indefinitely, is what the Fed has said, until they see certain criteria met. So they're already printing $85 billion a month. I mean, how much more are they going to print? How much more debasement of currency? How much more of that would the general public sit back and say, yeah, it's fine, keep doing this? So, as I've said, they're painted in the corner, and the concern is, at the lofty heights we sit at, it's a question of how is that going to be maintained. When you look at history, productivity is what usually fuels the stock market, not central bank interventions, because they can only intervene so long before the rest of the world will sit back and say, okay, this just isn't going to happen or turn out in a positive light. So if we pull back and look at the macro picture, what is underpinning this all-time high in the Dow Jones, and we're getting close to all-time highs in the S&P 500, and the NASDAQ is still pretty far off. So if we look at, and I've used this recently in a commentary, if we look at 2007, when the last time the Dow Jones was at all-time highs, and now, and compare just some primary economic data points. Are they better or worse now? Gas prices are, we'll call it a full dollar higher. Number of unemployed Americans have doubled. Number of Americans on food stamps, well, almost doubled. Fed balance sheet from less than $1 trillion to over $3 trillion at this point, and growing by $85 billion a month. The base money supply from $856 billion to almost $3 trillion, so we'll call that more than doubled. Price of gold doubled, which, as a funny aside, who would have done better? Somebody that dropped money into the Dow Jones Industrial Average in the October of 2007, to now, or somebody that put their money in gold to now. Consumer confidence. Consumer confidence is still, we'll call that, 25, 26% less than it once was. 10-year Treasury yield, way lower than it once was. That's not a good sign. Total U.S. debt outstanding, again, getting close to double. It'll exceed double based on the current trajectory of spending versus what the country takes in. Case-Shiller Housing Index, still much lower. So you can see, I could list off many, many more things that are much worse now than they were then. Yet, the S&P, the Dow Jones, all these stock indexes are hitting all-time highs. And the question is, how can that be, Henry? And the answer is, it's Fed intervention. If you print money, it's got to go somewhere, and it's being railroaded into stocks by keeping interest rates low and forcing investors out into risky assets. So it's not that most investors sit back and say, "Oh, yeah, I want to buy some stocks today." They feel compelled to buy because they're not going to get "quote unquote" a return anywhere else. But squeezing everyone into the same box isn't necessarily the best thing. In our second chart here in the bottom, we have the average quarter-over-quarter change in G20 GDP and weighted GDP. And the reason I did a weighted versus non-weighted is because obviously countries like Indonesia aren't as big a part of the world as the United States is. So what I did was, and in the end it doesn't matter because the way the chart flows between the two, it's the same. It's just slightly off in terms of percentages. But what we can see is since 2010, the average quarter-over-quarter change in GDP around the planet, and the G20, which is a group of 20 countries, mostly industrialized, 10 of which are industrialized, and 10 are emerging market countries like Brazil, Indonesia, Turkey, and so forth. What we see is GDP is sliding. I wouldn't even call that gradual. That's a pretty steady slide down. Again, yet we see the stock markets moving up, not on sound fundamentals, which means this is a market being built on sand, which, again, begs to the idea of caution. So let's just back up for a second and take a very quick exercise. And what I've done is I've charted in the top the Dow Jones Industrial Average, which is priced in dollars, right? I mean, the stocks of the Dow Jones are priced in dollars. What happens to this, call it upward chart, if we price the Dow Jones Industrial Average in gold, which is not something that can be printed and manipulated in terms of adding more to the system? We see the chart is turned inside out. And you say, all right, well, Henry, it's gold. Well, let's use something else you can't print, but is important in the world. How about oil? Here's the Dow Jones priced in oil, right? It's not quite as rosy a picture. So I guess the point here is all this money that's flooding into the system through monetary easing around the world is boosting stock markets, but these are fleeting gains. And it's just my opinion that it's the people that sold here and decided to re-enter here, sold out somewhere up here and decided to re-enter down here. The question is this a point to be greedy or cautious? It doesn't, in my opinion, it doesn't matter what you've done between these periods of time. It matters where you are right now and where you are going forward. And I say this is a period of caution. It doesn't mean the market can't go up further. I'm sure it will. But every percent up, in my opinion, is getting us closer and closer to a point where the markets are going to pull back because the fundamentals just are that. So what we have here is heat maps for two different periods of time, 2006 and 2012. 2006 obviously was before the dot-com blow-up. And what we see is the different risks that were embedded, we'll say it, in the economy, in the markets. And so what we see is the light blue is interest rate risk. In 2006, there wasn't really a whole lot of interest rate risk. Rates were at a reasonable level at that point for the size of the economy and size of the debt and so forth. Currency risk, very low in terms of the default. The monetary base, again, was reasonable relative to GDP and those types of things. Inflation risk, a little bit higher because we were, still amassing a lot of money in the monetary base. The black one, political risk, again, slightly higher just because of what was going on at the time. Market risk was starting to grow. We were, further away from the bottom in the dot-com blow up. We were also starting to hear the inklings of the problems that were to come in 2008. Then we have overall economic risk. It was growing based on what was happening in the markets with, collateralized debt obligations and the real estate bubble and that kind of thing. So let's fast forward to today. And again, these are my opinion, but I haven't really had anybody argue with me to say, yeah, you're probably right. 2006 was much less risky time in terms of, if you look at economic data points. So now we sit, interest rate risk is super high because interest rates are at zero. They have nowhere to go but up, which means that is a drag on the bond market and the stock market. Currency risk is at all-time highs. It couldn't really be higher. Inflation risk, very high. Inflation's already happened because the money printing is going on. And then we also have market risk. Market risk is, again, probably at all-time highs. I would even push that up a little more because the underlying economy does not support where the stock market is. The only thing supporting it is Fed intervention. And if you don't believe me, just do a small mental exercise and think to yourself, what happens to the U.S. stock market if the Fed tomorrow decides to raise interest rates? I assure you it is not a good outcome. Political risk has gone up. I wouldn't call it severe, but it is up because people are beginning to get frustrated with the political system. Therefore, we're seeing that with the fiscal cliff and all the other debates that are going around debt and those types of things and budgets. And then economic risk is exceedingly high because we have interest rate, currency, inflation risk. That just lends itself to economic risk. So what is the portfolio design? I didn't just make up, well, I did, but it's not random that I've designed portfolios the way I have. And just about all clients, there's a few clients that have, we'll say, more precious metals than others. There are some clients that have a more conservative portfolio with some things that don't show up on this list. But I would say 90% of my clients have the holdings that we're looking at right here in some percentage within these percentage windows that I've listed. So I look at the stock market and say, okay, the risk in the stock market is very high, in my opinion, because of the things I've outlined. So therefore, do I want to be taking the full risk? It's kind of like when it snows outside, you don't go the speed limit or greater when the roads are dangerous. You slow down. And there's knock-on effects of slowing down, and one is you're going to get to your destination slower. And it's the same thing in investing markets. If the risks are high, you have to take down the amount of risk you're taking in the portfolio. Otherwise, you can see a severe drawdown in the portfolio. So in the growth allocation of portfolios, I'm just going to run down real quick. The PowerShares Technical Leaders, this is a broad-based U.S. stock fund that has had really good performance throughout history, or throughout its history. It's basically a proxy of the U.S. stock market that I use. The equal weight technology is just that. Instead of using an index that heavily weights Google, Apple, and Sun Microsystems, this equally weights across hundreds of tech companies. Therefore, again, it limits the downside exposure that one company might bring, like Apple, which has had pretty heavy losses in the past 6 months. Consumer staples. These are just your bread and butter U.S. companies where you're going to find Johnson & Johnson's, those types of companies. Next one on the list, PowerShares Emerging Markets. It's just that they're the emerging market countries around the world. Well-run fund. It's not just China and Brazil, the big countries. It goes into some of the lesser-known emerging market countries that have sound fundamentals. And the Robeco Long Short basically is a fund that invests for upside in the market, but has a little protection in terms of shorting or benefiting if the market should slide the other way. So it's a way to get some market performance without taking all the market risk. On the inflation hedge side, what we see is we have gold miners, Realty Income, Plum Creek Timber. These are real assets. Inflation hedges are going to be anything that's real assets. Quite frankly, precious metals are inflation hedges as well, but I have them identified differently. So gold miners have been gotten really beaten up lately. But again, if you're bullish on gold, this is a great long-term play on continuing to print money around the planet. Realty Income, it's backed by real estate. I mean, again, you can't print real estate, you got to build it, and somebody's got to rent it or own it. Realty Income invests in a bunch of single-use properties. It pays a great dividend. Single-use meaning standalone buildings where you might find a CVS or Advanced Auto Care or something like that. And then Plum Creek Timber, it's a timber company. If the market's recovering truly, which I doubt, but if it truly is, and we have this global recovery, then we're going to see Plum Creek Timber is really going to do well because you're going to have building. And if it's not, and they're printing more money, Plum Creek Timber should hold up really well because again, you can't print trees, or you got to wait for them to grow. On the purchasing power hedge, at 20% across almost every client, or more in some cases, we have the Central Fund of Canada and Central Gold Trust. This has been one of the biggest drags in the portfolio, quite frankly. One of the biggest reasons performance in the last year has suffered for clients. But that does not, in my opinion, mean you vacate that space. You have to protect purchasing power. And the reason the metals are getting beat up, in my opinion, and many, many other people's, is it's monkey business. It's the shenanigans of manipulation. And people scratch their head and say, Henry, how can they manipulate that? Well, they manipulated LIBOR, which was global interest rate setting mechanism. They manipulate interest rates on a regular basis. Every time the Fed says we're going to lower interest rates, that's manipulation. It's not the market, free market, determining the values. So the next question would be, well, Henry, why bother investing in precious metals if they're manipulated? Well, there's very few assets that have made money for 12 years in a row. And that's happened because the continuation of a currency war of debasement of currencies. So it's tough to just sit on it and watch it get moved around the way it is. But if you believe, as I do, that the economy is not truly on the mend and that they're going to continue to print money, and global governments aren't really working in the correct way through to fix the systemic problems that are out there, this is a hedge you have to keep on the portfolio so long as interest rates are negative and they're still printing up money the way they are. And then last section we have, or next to last, is equity hedge. And this is, PIMCO Bond is a strategic bond fund. iShares corporate bond and permanent portfolio all hold bonds. Permanent portfolio holds a little bit of stocks and precious metals. But these are hedges. These tend to do really well, hold up really well in very volatile stock market periods. And I think those are coming. I mean, we've already seen them last year and the year before. I think we're going to continue to see that. And then cash, I hold very little right now because, again, with debasements, I don't really want to hold cash as an asset for any length of time. Should the market pull back, I would certainly consider increasing cash in the short term to protect portfolios. So, the bottom line is, I look at the market and see what I see. I can't make you see what I see. My hope is that you would say, yeah, I agree with you, Henry. I see what's happening. And if you do, I think the way I've had the portfolio structured is the best way, and what to get through to the other side of the next correction in the market. So what we have here is what I call the worst case scenario. And what we're looking at is from 1984 to today, the Japanese stock market. And what we see is the market didn't recover. We've seen two booms in the United States. They saw a little one here in 2000. They saw a bit of one into 2008. But they've gotten nowhere close to recovering. And this is what it's like to have a recovery that's not, or no, a non-recovery, a non-V-shaped recovery like we've had from 2000 going into 2008 and then 2008 till now. So what happens, what happened in Japan is, demographics is going against them. They also have less participants in the stock market. People just said forget it because they got wiped out and they've not returned to the stock market. And the chart speaks for itself. My fear is the next downturn in the stock market could turn out like this for the United States, because twice now we've seen huge drawdowns in the market. A lot of people are getting frustrated, not wanting to take the risk. So the systemic risks are very high at this point, meaning whether it's in global banks, countries like Greece, Portugal, Spain, Italy, Japan, wars, the things going on in the Middle East. I mean, any one of these things could tip a very significant drawdown in stocks. And the tools to boost it back up, printing $85 billion a month, we're already doing it. It's not really having a huge effect, or it hasn't had a huge effect on the economy. It has on stocks, but those are, again, falsely inflated and easy to draw down. And then second, interest rates are already at zero. So as we saw in one of the first slides, the fall-offs in the market have become deeper when they happen, and they come faster. And my fear is and it's very real, because think about it, Lehman Brothers and Bear Stearns are already gone, so that leaves Morgan Stanley, JP Morgan, Bank of America, and Goldman Sachs. And everybody knows they're too big to fail. The Justice Department already said they won't prosecute them because of the fear they would sink the economy. Well, they're going to sink themselves anyway, and the government won't be able to bail them out because they're taking on excessive risk. They still are. JP Morgan itself holds like 60 trillion in derivative securities. That's 3 to 5 times the total GDP of the United States held at one bank in derivatives. So the point here is that the market is a very dangerous place, and I'm not willing to gamble client money in what has become a casino. With the stock market. I mean, you ask some of the Japanese citizens, would you have been happy to sold out somewhere around here? I would imagine most of them would say yes. So the issue really is, if you get 3, 4, 5% returns and the market's up 10, you could look at it as the glass is half full or half empty. I look at it as you've been cautious in a period of time that has been exceedingly risky. My goal is to provide risk-managed returns, and the risks are high. There's a little saying I read recently that people don't insure risks that they don't see. Meaning, if a young person that says, "Oh, I'm healthy, I don't need health insurance," they're not going to buy health insurance, or they might not buy it. But when they need the insurance, they're not going to be able to get it. And the same thing now. Which, in other words, what I'm saying is, should we see we'll just pretend, spitball something and say, all right, Goldman Sachs runs into some problems and they need a bailout, and we get some crisis, or it happens in Europe. The market is going to sell off fast, and they'll bring in what are called market holidays, where they just shut down not the banking system, but they'll shut down the Wall Street or the stock exchanges, where you can't get out. And then when they reopen again, everybody's going to flood to get out. And I'm not making this up. This has happened in the past, and it would not surprise me to see it in the future. So being prepared for those types of things, where your ability to get out is restricted, would not surprise me, because, again, the tools to boost the economy have been used at this point. And now there's a reason why 38 countries around the world are at either negative interest rates or zero interest rates. So I'm going to wrap it up at that and just say I'm doing what I believe in terms of portfolio construction to be what I think is in the best interest of clients. If after you listen to this presentation you say, well, I don't necessarily agree, I think I'd like to take more risk in the portfolio, then feel free to call me, send me an email, and we should get together if we can. If you're out of town, then we should talk on the phone. But my goal is to make sure you're comfortable with how your money's being managed. It's not a fight between what you want and what I want. It's your money, and you've trusted me to manage it, and I'm doing that. If the returns are subpar for the conditions, then you should let me know that. But I think, given the conditions, I'm more than happy to. Me personally, I'm more than happy to take lesser return in a high-risk environment. As I've said before, if it's a snowy night, you're not going to drive the speed limit or greater to get to somebody's house. You're going to drive slower, and that means you get there later. Same thing here. If you slow down the risk in the portfolio, you're going to slow down the returns. But there's a reason for doing that, which is the risk levels are high. So I'm going to wrap it up there. I appreciate your time and your patience. And as I said, if you have concerns, issues, questions, please reach out and talk to me. I'm happy to work with clients in any regard that makes them sleep well at night. I sleep well at night knowing that I'm doing what I think is right for clients, but it's important to me that you agree that prudent measures are being taken to manage your money. In the end, what I want is to see your wealth retained in what I consider a capital hostile environment. It's my opinion that in the next 5 or 10 years, we're going to see a huge buying opportunity in stocks, meaning after we see the Fed get out of pushing stocks up and it get back down to a reasonable level, it's going to be the people that are cautious that will be able to retain their wealth and be able to buy things dirt cheap, in my opinion. So again, thanks for your time and patience, and I look forward to continuing to work with all of you.